the start of the new month means only one thing. It's time for the latest non-farm jobs report from the States. There's increasingly going to be more and more pressure put on these upcoming non-farm jobs reports, thanks to what the Fed said last Wednesday. Jerome Powell and co were keen to stress that substantial further progress needs to be made regarding full employment and the 2% inflation target before they start to turn off the stimulus taps. However, on the topic of tapering, Powell stated they wanted to see a string of strong jobs reports before having those discussions. When asked to clarify, the Fed chair defined a string as simply more than one, meaning there is a chance that tapering talk could arise at the next meeting in June, dependent on the next couple of non-farm payrolls. And already the jobs report is coming off a hot month. April's headline figures surged past expectations, coming in at 916,000 against the 652,000 forecast and the 468,000 posted the month prior. That's almost double month on month. The unemployment rate, meanwhile, shot down from 8.2% to 7.5%, easily beating expectations of 8.0%. As ever, the one disappointing figure was wage growth, which contracted by 0.1%, but it was far outweighed by those two headline numbers. This time out on Friday, analysts are looking for another 900,000 plus reading, potentially around the 925,000 mark. If so, that would be the strongest monthly figure since the numbers reported at the start of September 2020. That kind of number would also potentially pose a conundrum for investors. While signs of an American economic recovery are to be celebrated, anything that nudges the Federal Reserve towards reconsidering their current monetary policies is hugely worrisome for the markets, given that so much of the recent growth in the last few months has been predicated on monetary stimulus and fiscal stimulus from Joe Biden. That then makes Friday's non-farm jobs report a tricky one to trade. It could be the kind of thing where we've seen, in the past, given certain circumstances, a strong non-farm number could actually harm the financial markets. Since first touching 34,000, the Dow Jones has struggled to make any sustained charges beyond that level. How investors then choose to react to Friday's jobs report, especially in the case of the strong headline reading, may then set the tone for the rest of the month, and whether the Dow will find itself struggling to defend 34,000 or well on its way towards 35,000. As mentioned, we are potentially getting into the territory where a good non-farm number is actually bad for the markets because of the implications it has for the Fed's monetary policy. Before Friday's main event, the US is faced with the latest factory orders data on Friday, the final services PMI and ADP non-farm employment change reading on Wednesday, and the usual Thursday jobless claims figure, which has been hovering between 545,000 and 575,000 for the last 3 weeks. The main portion of earnings season also starts to wrap up this week. Pfizer, General Electric, and American Express report on Tuesday, or PayPal, General Motors, and Uber update on Wednesday. As mentioned, though, there is really no question about what will be the focus in the first week of May. Bar some unforeseen event, these non-farm figures on Friday are potentially going to be as important as they have been for the last 13 months, since those first disastrous figures at the start of the pandemic and then the rebounding figures that came a couple of months after. We're really getting to the point where each non-farm jobs report is going to have huge implications for Federal Reserve monetary policy, and then therefore they're going to become incredibly difficult to trade every first Friday afternoon of each month for the next few months at the very least.